This is a balance sheet, not a corporate balance sheet, a market balance sheet. Supply on one side, demand on the other. For most commodities, these numbers roughly balance. Production meets consumption. Inventories fluctuate within normal ranges. The market clears. Silver's balance sheet doesn't balance. It hasn't balanced for 5 consecutive years, and the imbalance in 2026 has reached a scale that the market has never experienced, a scale that raises a question no analyst wants to ask out loud. What happens when a market runs out? The Silver Institute's preliminary 2026 data, released at 5 a.m. London time this morning, shows total silver supply of 980 million ounces. Mine production of 820 million ounces, flat with 2025 as depleting ore grades offset new project ramp-ups. Recycling of 160 million ounces, down 8% as high prices incentivize holding rather than scrapping. Total silver demand, 1.37 billion ounces. Industrial demand of 710 million ounces, up 16% driven by solar, electronics, and EVs. Investment demand of 340 million ounces, up 44% as monetary instability drives safe haven buying. Jewelry and silverware of 260 million ounces, flat. Photography and other uses of 60 million ounces, declining but still material. Supply, 980 million ounces. Demand, 1.37 billion ounces. Deficit, 390 million ounces. But that's not the number that matters. The number that matters is cumulative. 2022 deficit, 140 million ounces. 2023 deficit, 180 million ounces. 2024 deficit, 210 million ounces. 2025 deficit, 230 million ounces. 2026 deficit, 390 million ounces. Cumulative deficit over 5 years, 1.15 billion ounces. Cumulative deficit through first half of 2026 at the current run rate, 890 million ounces. 890 million ounces of silver that was consumed but not produced. 890 million ounces that came from somewhere, from above-ground inventories, from ETF holdings, from exchange warehouses, from private vaults. 890 million ounces that are gone and not being replaced. The question isn't whether the deficit is real. The data is published. The numbers are verified. The question is how much longer inventories can fill a gap this large, and what happens when they can't. Here's what they're not telling you. Above-ground silver inventory is finite. It accumulated over decades of surplus production. It peaked around 2015 at approximately 2.6 billion ounces. Since then, it has been drawn down year after year to meet demand that production cannot satisfy. The drawdown isn't visible in any single data source, because silver inventory is distributed across dozens of categories that report inconsistently, or not at all. COMEX registered inventory, 31 million ounces today, down from 152 million in 2021, a 79% decline in 5 years. LBMA Vault Holdings, approximately 850 million ounces, but that number includes metal allocated to ETFs, roughly 650 million ounces, metal pledged against loans, metal held in custody for industrial users, and metal that's been sold forward but not yet delivered. The freely available portion, metal that could actually satisfy new demand, is perhaps 150 million ounces. ETF holdings, 1.1 billion ounces at the 2021 peak, now approximately 780 million ounces. A 320 million ounce decline as investors redeemed shares and the underlying metal was sold to satisfy industrial demand. Shanghai Gold Exchange inventory, 2,847 metric tons, 91.5 million ounces, down from 4,200 tons in 2024. A 32% decline despite China being a net importer. Private vaults, dealer inventory, industrial stockpiles. Unmeasured, but industry contacts report historically low levels across the supply chain. Refiners report working with minimal buffer stock. Mints report production delays due to blank shortages. Dealers report extended shipping times as they wait for restocking. Add the measurable declines. COMEX down 121 million ounces since 2021. ETFs down 320 million ounces. LBMA estimated down 200 million ounces of freely available metal. Shanghai down 43.5 million ounces. Total measurable inventory decline since 2021, approximately 685 million ounces. The cumulative deficit over the same period, approximately 890 million ounces. The 205 million ounce difference represents drawdowns in categories that aren't publicly measured: dealer inventory, refiner working stock, industrial buffers, private holdings. The unmeasured drawdown is necessarily occurring because the measured drawdown isn't large enough to cover the deficit. The inventory is depleting faster than the data shows because some of the depletion is invisible. This is where the lie becomes unsustainable. To understand why we're 6 months from potential collapse, you need to understand the trajectory of the deficit and the trajectory of the inventory. The deficit isn't stable, it's accelerating. 2022, 140 million ounces. 2023, 180 million ounces, plus 29%. 2024, 210 million ounces, plus 17%. 2025, 230 million ounces, plus 10%. 2026, 390 million ounces, plus 70%. The 2026 acceleration comes from two sources. First, solar panel installations are growing faster than forecast. Global solar capacity additions reached 580 gigawatts in 2025, up from 510 gigawatts in 2024, and are tracking towards 700 gigawatts in 2026. Each gigawatt requires approximately 850,000 ounces of silver for solar cell contacts. The 2026 solar build-out alone will consume approximately 595 million ounces, 72% of total mine production. Second, investment demand has spiked as monetary instability drives safe haven buying. The 2025-2026 period has seen currency crises in multiple emerging markets, banking stress in Europe, and inflation persistence that has shattered confidence in fiat currency stability. Silver investment demand, coins, bars, ETF inflows, has increased 44% year over year as investors seek physical assets. The supply response has been negligible. Mine production has been flat for 3 consecutive years, despite silver prices more than tripling. The mines that could have expanded production chose not to, because silver is primarily a byproduct of copper, lead, and zinc mining. Silver prices don't drive production decisions, base metal prices do. And base metal economics haven't justified the massive capital investments required to meaningfully increase output. The deficit is widening while supply remains stagnant. The inventory that bridges the gap is finite and depleting. At some point the lines cross. Inventory reaches zero. The gap can no longer be bridged. At current deficit rates, 390 million ounces annually, or 32.5 million ounces per month, the remaining measurable inventory of approximately 200 million freely available ounces depletes in 6 months. 6 months. July 2026. The point at which the silver market, under current trajectory, runs out of inventory to satisfy demand. When inventory reaches zero, the market doesn't gradually adjust, it breaks. The mechanics of what happens when a commodity market exhausts inventory are well documented, but rarely experienced because markets usually adjust before reaching that point. Price rises, demand falls, supply increases, equilibrium is restored. Silver isn't adjusting. Price has tripled, and supply hasn't responded. Demand has actually increased as higher prices drive speculative interest and as industrial users stockpile to protect against future unavailability. The normal adjustment mechanisms are failing. At 9:30 a.m. New York time on Thursday, the CME Group announced enhanced position limit monitoring for silver futures. Bureaucratic language for preparing to intervene if trading conditions deteriorate. The exchange isn't predicting a crisis, but they're preparing for one. They're reviewing the rules they'll invoke when physical delivery becomes impossible. COMEX rules allow for cash settlement when physical settlement cannot occur. Rule 104 permits the exchange to take any action necessary to maintain orderly markets, including forcing cash settlement, adjusting delivery terms, or suspending trading entirely. These rules have never been invoked for silver. Their existence acknowledges the possibility of a failure that no one wants to discuss publicly. Less than 180 days remain before the inventory trajectory suggests exhaustion. That timeline is an estimate based on current deficit rates and visible inventory. The actual timeline could be shorter if deficit rates accelerate, if inventory is lower than reported, or if a demand spike, a banking crisis, a currency collapse, a geopolitical shock, triggers hoarding that accelerates drawdowns. The timeline could be longer if prices rise enough to destroy demand, if industrial users substitute away from silver, or if supply somehow responds despite years of non-response. The bull case for the timeline requires things to change that haven't changed despite every incentive to do so. While one side depletes, the other side accelerates. The entities driving silver demand aren't slowing down, they're speeding up. China's solar panel manufacturing capacity is expanding by 35% in 2026. The new factories coming online will require silver that the global market may not be able to provide. Chinese manufacturers are responding by securing supply agreements directly with mines, bypassing the exchange system entirely. Every ounce they lock up is an ounce removed from the freely traded market. At 2:15 p.m. Beijing time on Wednesday, LONGi Green Energy announced a $4.2 billion supply agreement with Fresnillo, the world's largest primary silver producer, securing 40 million ounces annually through 2030. The agreement represents 5% of global mine production locked into a single buyer. Similar agreements are being negotiated across the industry. The exchange-traded market is being bypassed by bilateral deals that guarantee supply to those who can pay. India's silver imports set a record in Q4 2025 and are tracking higher in Q1 2026. Cultural demand for silver jewelry and religious items is price inelastic. Indian consumers buy silver for weddings and temples regardless of price. Investment demand is also surging as the Indian middle class seeks protection against rupee volatility. India absorbed 340 million ounces in 2025. If the pace continues, they'll absorb 400 million ounces in 2026, nearly half of global mine production going to a single country. The Western investment community is waking up to the supply crisis. Silver ETF inflows in January 2026 totaled 18 million ounces, the highest monthly inflow since 2020. The SLV Trust alone absorbed 12 million ounces. Investors who previously viewed silver as a speculative trade are now viewing it as a hedge against systemic instability. Their buying adds to the deficit that's depleting the inventory they're trying to access. Every category of demand is growing. No category of supply is responding. The deficit widens. The inventory shrinks. The timeline to exhaustion shortens. This is what a market looks like before it breaks. The data is available. The trajectory is clear. The arithmetic is undeniable. Supply minus demand equals negative 390 million ounces. Cumulative negative equals 890 million ounces. Remaining inventory to bridge the gap equals 6 months. And yet the market trades as if equilibrium will somehow appear, as if supply will materialize from sources that have been declining for 5 years, as if demand will moderate despite every driver, solar, EVs, investment, emerging market consumption, pointing toward acceleration, as if the deficit can continue indefinitely because it has continued so far. Markets don't price discontinuities until they happen. They price the present and extrapolate. The present is a functioning market where silver is available at $76 per ounce. The extrapolation is that silver will remain available at some price. The discontinuity, the moment when silver is not available at any price because physical inventory has exhausted, isn't priced because markets don't price events that have never happened. But the event is approaching. The arithmetic says so. The inventory data says so. The trajectory of every variable, supply flat, demand growing, deficit widening, says so. Some will look at the deficit data and assume the market will adjust. We'll trust that $100 silver will bring supply online. We'll believe that industrial users will substitute. We'll expect that someone, somewhere, will solve the problem before it becomes a crisis. These are the same voices that have been predicting market adjustment since the deficit began in 2021. The adjustment hasn't happened. Supply hasn't increased. Substitution hasn't materialized at scale. The deficit has widened from 140 million ounces to 390 million ounces, while the voices kept predicting adjustment that never arrived. Others will calculate the runway. We'll notice that 200 million ounces of freely available inventory at 32.5 million ounces of monthly deficit equals 6.15 months. We'll understand that the July 2026 timeline isn't prediction, but arithmetic. We'll recognize that the market's failure to price the exhaustion doesn't mean the exhaustion isn't coming. The informed are not predicting what silver will cost when inventory exhausts. Price discovery in a shortage of this magnitude is genuinely unknown. No modern commodity market has experienced total inventory depletion while demand continued growing. What the informed recognize is that the trajectory leads somewhere unprecedented, that the timeline is months rather than years, and that the current price reflects a market that doesn't believe what the data clearly shows. This is not financial advice. This is not a recommendation to buy silver at current prices or any prices. Markets in disequilibrium can remain in disequilibrium. Prices can fall before they rise. Timelines can extend. Assumptions can prove wrong. But the arithmetic doesn't lie. Supply, 980 million ounces. Demand, 1.37 billion ounces. Deficit, 390 million ounces. Cumulative deficit, 890 million ounces. Remaining inventory, approximately 200 million ounces. Time to exhaustion at current rates, 6 months. The Silver Institute published the numbers. The COMEX published the inventory. The trajectory is documented in data that anyone can access. The market is 6 months from discovering what happens when a critical industrial metal runs out. 6 months from a price discovery event unlike anything in modern commodity history. 6 months from learning whether the price that balances a market with no inventory is $200, $300, or something that doesn't fit on current charts. 890 million ounces gone. 200 million ounces left. 390 million ounces of annual deficit still running. The arithmetic has an answer. The answer arrives in July. And the only question left is whether you understood the arithmetic before the market did, or whether you'll be among those discovering the answer when it's too late to prepare. The deficit is real. The inventory is finite. The timeline is 6 months. Everything else is denial.